session of day 3. We are delighted to have Narayana Kocherlakota with us today to give us the keynote talk. Narayana has a perfect background for what we want to talk about today. He's currently at the University of Rochester as a professor of economics, but he has been at several other universities over his time. He was also the president of the Minneapolis Fed from 2009 to 15. During that time, he was on, for at least some of those years, was on the FOMC. So he has been in one of the hot seats in terms of thinking about and setting monetary policy in this small little country called the United States. So he has been there, he's been thinking about these issues, and what he's going to talk to us about for the next half hour or so is the 21st century credibility problem. We've been talking about credibility in the last few sessions. My guess is it's going to come up in the next session, and it's going to come up with a panel discussion tomorrow. So Narayana, thank you very much for joining us. The floor is yours, the microphone is yours, and let's hear what you've got to say about credibility in the 21st century.
Well, thanks a lot. Thanks for inviting me to give this talk. Thanks for thinking to include me in the conference. It's been a very interesting set of presentations that I've heard, and I hope to stimulate some further conversation with my own presentation. All right, so what I'm going to talk about, as Chris alluded to, is I'm going to talk about the 21st century credibility problem. And what I want to talk about is that the theory and the evidence from this century, from the 21st century, seems to suggest that we have an asymmetric credibility problem. It does seem, at least based on what we've seen in the last 50 years, the central banks have learned over the passage of time to be able to eliminate outcomes with persistently above target inflation, undesirably high inflation. But they are not able to preclude outcomes with persistently below target inflation. So if you want to tune out at this point and not pay any attention to the rest of what I'm going to say, then you just want to take away the following message: only ceilings are credible, not targets. I think a very important open question is, can a concerted effort between monetary and fiscal policy acting together serve to keep inflation from being too low? But my message is going to be that without the help of fiscal policy, and in what way I think it remains an open question, monetary policy seems to struggle with keeping inflation from being persistently below whatever the target happens to be. So my talk has 5 parts to it. I'm going to have evidence, which is pretty sketchy, honestly, but it's evidence you're all familiar with. Then I'll talk about some theory, and I was told that I wasn't supposed to be too technical in what I was going to say. On the other hand, there's some pretty sophisticated thinkers in the audience, and so I'm sort of torn that I want to be able to talk in a way that lay people are engaged in what I'm saying. On the other hand, I also want to assure my the specialists in the audience that what I'm saying is largely right. And so I'll try to walk that line, probably leave nobody happy, but that's going to be especially in sections 2 through 4. And then I'll close with what I perceive to be the lessons of the theory and the evidence. Let me start with the evidence. This is not new ground by any means. Interpretation, I think, is perhaps a little more mine, but again, but even that statement is a little too strong. I think others have reached the same conclusions. So, in the wake of Bretton Woods in 1972, I think the world embarked on what was a remarkable policy experiment. As the advanced economies really became a purely fiat monetary system, there's no notion of backing of any kind from whatever metal you wanted to choose or whatever commodity you wanted to choose. And we'd seen obviously short bursts of this in the past, but this was something has now gone on for years, almost for a full half century. And what has been the outcome of this? Well, I'm going to look at a couple of one variable in particular, and there are those who would quibble with my focus on this variable, but there are reasons from a central bank perspective. I think there are reasons why we want to be thinking about this variable in particular, and that's inflation. And my message, I think, I'm most familiar with the U.S. data, and I think my message is clear when we look at the U.S. data. The message from the data is clear that I want to draw, and that is that if we went back to the early part of the Bretton Woods period, we see the problem that we might have anticipated with a purely fiat system, that inflation gets high, undesirably high. We see, those of us who are old enough remember that President Ford was circulating buttons under his administration and whip inflation now. So clearly got the attention of the President of the United States and people as a whole. And then Paul Volcker is brought in the late 70s to be the chair of the Federal Reserve System with the goal of bringing down inflation, even if it is costly to the elected president, Jimmy Carter. But all of this is, I would say, at a loose level, what you would have expected from a system where you've decoupled money from any kind of backing. Fast forward to the last quarter century, the second quarter century of our experience so far with this fiat system, and the situation is different now, and that is that inflation has consistently run below the levels that the central bank considers to be desirable. There are, I think, a couple. This is just a univariate time series, and of course, you can't draw necessarily any firm conclusions from this. One possibility is that the Fed has gotten what it wanted, and that is it was aiming to get below 2% the whole time, and it has delivered on that. I'm going to take a different perspective, and I think my second perspective is consistent, at least some of the language you've heard more recently from the Fed. That is that they were hoping to get and trying to get inflation back to target, and were surprised by their inability to do so. But that's going to be the main observation. I'm going to look at some other countries, but the main observation is going to be inflation in the second part of this 50-year period has been, we've had a surprise, which is that it's not been too high. It has been, if anything, too low. Now, the too low part is, on a scale basis, far smaller than the too high problem, right? We're talking 6 percentage points, 7 percentage points above what the U.S. viewed as desirable. And here we're talking less than 1%. Okay, so that there is a difference in magnitudes, but nonetheless, I think that's the second part of the sample tends to deliver that message. I'm here in Canada. I think you can draw a similar message from Canada. I think that if you get to the very end of the sample, Mick mentioned on Tuesday that the Bank of Canada has been more successful than other IT banks. I think you see that very clearly towards the end of this sample. And here I'm looking at core, so it's not just about gasoline prices or something like that. So I think but nonetheless, I think there's this consistent tendency, even in the Canadian data, to see the core inflation has undershot the 2% target. I use CPI here. I think most central, I'm using core CPI for Canada. I use core PCE for the United States. The US likes to target the PCE price index instead of the CPI, as you all know. The UK, again, I'm going to argue here the scale issue is very tough because The UK had a real inflation problem in the 70s, not one of these small problems that the US or Canada had. And so again, a little bit of a scale problem. But nonetheless, again, I would argue that we see this challenge with inflation running persistently, tending to run persistently below target as opposed to at or above target. Germany, here my comment that that we don't know whether this is because of what the central bank really wants, or if it's because their inability to achieve the desired objective. But we see here that the post-Euro, the post-ECB period, inflation has run consistently below target in Germany. I picked Germany somewhat at random. I could have picked other European countries who would have seen the same experience. And in fact, arguably, I think the Germans have had more success at getting to 2% inflation in the last 10 years than other parts of Europe. And in their experience with high inflation was less exaggerated than we saw, for example, in the UK. But again, I think I'm going to try to send the same message to you that the second part of this Bretton Woods, the second part of this post-Bretton Woods period has been marked with low inflation, undesirably low inflation, not undesirably high inflation. Now, I think the best case I can make for my argument from the data is Japan, because of the fact that there's one piece of this that I think is a little misleading, which is, it's not at all clear that Japan was aiming for 2% throughout this whole period. In fact, we see explicit declarations from the Bank of Japan that they're really aiming at something considerably lower than that. But with that said, I think in the very latter part of this period, in the Abe and Kuroda period, Japan has been dedicated to trying to get inflation back to 2%. And back up to 2%, and has enjoyed relatively little success on that front. So I think Japan is really a good exemplar of what I have in mind, which is it is proven to be surprisingly hard to get inflation back to targets, even after it's run persistently below target. Okay, so this is on the inflation front. I'm going to go to this. I'll come back to those slides I flashed through too quickly in a moment. So this is the post-Bretton Woods experience. And this is one person's summary, and I'm sure others might have a different look. The first decade or so, you have undesirably high inflation. And perhaps this is, as I would say, it's not surprising maybe in a pure fiat system. If you ask people, what do you expect in the wake of Bretton Woods, what would you expect? I would expect overly high inflation. In fact, for those of us who engaged on, after I left the Fed, I was active in Twitter for a while. I was, active in blogging for a while. Those of us who are active in that space, there are many, many people who so firmly believe this logic that they are sure that inflation must be mismeasured somehow, because otherwise, this has to be true. So I think this is a very logical connection for many people in the world, and those of us who are, trained long enough ago, then certainly it seems like a logical connection as well. But the last 20, 25 years, we see the opposite problem, that inflation has been consistently below target, and I'm going to claim undesirably so. And it is important to recognize this is a slight problem, not we're not at minus 8% inflation. And we're at at 1% inflation, and so I think that is important to keep in mind. Now, more arguably, and this is here, I'm going to go to the U.S. picture. In some sense, what I'm going to say is unarguable, and but the connection I'm going to make is the arguable part. So, per capita real GDP in the United States, if you look at that since 1972. Since the Great Recession, U.S. per capita GDP is. So what I've done here is I've drawn a trend line that links, I think, early 08 to to 1972. So that's the trend line. And these are logs if you're trying to read this y-axis. And then, but after that, we've seen slow growth. You look at this blue line; it's moving away from the red line. That's indicated slow growth, and we had no recovery on the fall in GDP. In a similar vein, we see labor share, although this decline starts before, to be clear, it starts before the Great Recession, starting in the early part of this century. And we see this very big decline, a relatively big decline in labor share, and it's stayed low since the Great Recession. Hasn't come back. Okay, so this is more arguable, certainly, that we've seen low labor share in the past 2 decades. We've seen low output in maybe more 12 years, low growth. I'm going to draw a connection between these observations and also low inflation. And that's connection is what the more arguable part is. I think I claim that we've been surprised by how poor these outcomes have been. That's not arguable. I think that if you go ask people, what do you think labor share is going to be in the year 2020? I think we're well outside any kind of range that they might have had in mind, or where output is today compared to what we might have thought at the beginning of the Great Recession. Is this due to other factors, technology? Many people have put that forward, and we can certainly discuss that later. But in this paper, I'm going to take in this rest of my presentation, I'm going to take the stance that there are reasons to think this is connected to low inflation. All right, so that's the evidence, my summary of the evidence, and what I'm going to now do is move into the theory. And this connection between real variables and inflation is going to matter in the theory, and so I don't want to underplay it. It is going to be important that there is a connection between what's going on in the inflation front and the real variable front. That's going to lead to the explanation that I'm going to give for why is it that it seems that central banks have learned to keep inflation under control from the point of view of not having it being too high, but have had less success in terms of getting it back up to target. So I'm now going to walk into the theory. And the theory is based on a recent paper I wrote that is called 21st Century Macro. It is a fantastic title, I will say. I say that because it's mainly fantastic compared to the paper itself. I think the title is great compared to the paper. The paper is struggling to live up to the title, but it does capture, to be more serious, it does capture sort of the broad brush look at the 21st century that it has offered you. And it focuses on the possibility of expectational effects, that the economies are experiencing low inflation, low output today, simply because people expect low inflation, low output in the future. And those expectations about the future prove to be self-fulfilling, because once you get to the future, people again are expecting that low inflation, low output down the road. It's really the long run is trickling back. Expectations about the long run are not pinned down in this model, and so the low expectations trickle back to where we are today. In traditional thinking, and this was very important when Chris mentioned I was at the Federal Open Market Committee. When we were forming our forecasts in, say, 2009 and 2010, was a very strong tendency among many members of the committee to say, we've got to get back to trend because there's this notion that shocks are temporary and we got to move back to where we're going to be in the long run. And that long run is pinned down by technological factors. Okay? In this model, that's not going to be true. The long run is susceptible to demand effects, aggregate demand effects. For those of you who are sitting there saying, I don't know what aggregate demand is, this talk is not going to help you with that. But for those of you who do know what aggregate demand is, this paper is going to feature permanent aggregate demand effects, that the people worry about low aggregate demand in the future, and that feeds back in a permanent way to today. So the main implications of the paper. And the first result is, I think, familiar from the New Keynesian literature, with a slight difference that I'll talk about in a few minutes. But by using what's called an active monetary policy rule, which is raising interest rates more than 1-for-1 with observed inflation, the central bank can eliminate these expectationally driven outcomes with above target inflation. So the central bank has learned how to get rid of this problem on the high end, that people are not going to be expecting inflation and output to be high in the future, and because this active monetary policy rule is going to kill this possibility. The second piece, though, is going to be that this can't happen on the downside. This approach of using an active rule, doesn't really matter what kind of rule you use, you're going to always have a whole set of just expectationally driven outcomes when inflation is below target, output, labor share, and the nominal interest rate are also low, and then growth will tend to be low as well if you have a flat Phillips curve. This just depends on the shape of the connection between output and inflation. The rest of this is independent of that. And the mechanism is going to be about entry and exit. Firms are going to be able to pay a cost to enter or pay a cost to exit. And if the central banks are using active monetary policy rule and there's an above target inflation outcome, we're going to get unbounded growth in output. And more importantly, unbounded growth in average production costs. If you have a diminishing returns production function, and you start to push up in the short run, at least, and you start to push up on the how much output you're trying to produce, then you're going to be paying a lot to do that, and firms are going to just walk away from that. They're going to say, that is too expensive. I'd rather just pay to exit. No matter how big your exit costs are, there's some choke point which the firm is just going to leave. So active monetary policy rules are going to rule out above target inflation outcomes simply by saying they would have to be supported by an expectation of very high, fast growth in production costs, which is simply not consistent with the potential for firm exit. The downside, there's no such a point of friction, of traction for the central bank in order to kill the downside possibility of below target inflation and below target output. All right. So let me talk about some details. And we have an audience with a heterogeneity in their interest in these details. I recognize that, but as I said, I've got the technical hotshots in the audience, and I have to say something to them. But I think that I've tried to make it so that it's interesting to the technical hotshots, but also provide some support to what I'm saying to the broader audience as well. So everything in this model is about expectations. There's no shocks to fundamentals. There's no COVID-19 in this model. You could add it, that wouldn't matter. It wouldn't affect things. In fact, there's a sense in which those shocks will make the expectational effects that I'm describing easier to generate, because you can always take a COVID-19 shock and make people think, well, we've got a disease that's going to be with us for 3 years, but I think things are going to be terrible for 10. I mean, that kind of just overreaction to a fundamental shock really makes the kind of expectational effects that I'm describing much easier to develop. But I'm not going to have that in there. The R star, I called it somewhat idiosyncratically R nat, but the R star is fixed in this model. It's not moving around at all. A key point, but it's very standard, is the average cost of producing output grows without bound as Y grows. And then the 1 period interest rate is going to be governed by a rule, a Taylor type rule, where you have inflation entering into an output. I'm going to say a very quick word about fiscal policy, but I'll come back to that. And this, now I'm really talking to the people who have interest in technical things, but technical things are critical in economics, so we have to say something about them. So fiscal policy here is what's called sometimes passive or Ricardian. And what this means is monetary policy is trying to do all the control of inflation on its own. And fiscal policy is standing in the background. Whatever inflation is, the government's intertemporal budget constraint is satisfied, that you don't need to worry about there being too much debt or too little debt. That's all taken care of. Essentially, tax obligations and debt are all set in nominal terms, in dollar terms. And so inflation doesn't affect that at all. We'll come back to talking about, when I said about fiscal policy helping out, we're going to might get away from that proposition about fiscal policy. All right. So my notion of nominal frictions, I think, is unusually flexible. I'm going to just kind of have a functional relationship between inflation and output. And this, this is a fun part of the paper. I think it's an important part of the paper. I show this kind of relationship can rationalize a lot of different ways. But the main way I emphasize, so one thing that's true in the literature, it really focuses on the cost of changing prices as a way to justify this. In my model, I don't have any of those costs at all. Prices can be changed at any time without paying any cost. What gives rise to a Phillips curve is non-rationality. So, and it can be non-rationality on an individual firm's part, or simply the belief on firms themselves are all behaving completely rationally, but they don't believe their competitors are rational. Or, to get into the nitty-gritty, they believe their competitors believe that their competitors are rational, but at that final step, there's a failure belief in the rationality. So this is, not common knowledge of rationality, to use the technical term. The point is, small deviations from rationality like this, and if that sounded narrow and technical, it is, but even small deviations like that can give rise to a Phillips curve-like relationship between inflation and output. And if you want lags in your Phillips curve and lagged inflation here, we can certainly put that in there as well in the paper. I've described how to do that. Entry and exit costs, very natural to put these in. Most modeling does have this. But in most monetary policy models, the new Keynesian framework, you won't see these entry or exit costs in there. So the reason to have exit, I described this at the beginning, is that if you have the possibility of exit immediately imposes an upper bound on output if you have average costs. Because here's what firms are making as profits. They're making output, what they produce. One is basically denote the numerator here is goods, and so this is just the price is one. And then average cost in terms of goods is going up as output gets bigger. Well, eventually this is going to go negative, and eventually it's going to get really negative, and so the firms are going to quit. And so there's going to be some upper bound on output, or this is going to get too negative, and the firms are going to quit. There's no such thing. There's no no lower bound on output, corresponding lower bound on output. So low output implies low average costs. So this 1 minus average cost is going to get very close to 1. But at the same time, Y is also getting small. And so, it becomes a little bit of a race, but in the model, as Y gets small, total profits are low. And so there's no sense in which there's going to be a desire. Well, it's not a race, excuse me. Y goes to 0, this is going to 1. So, if Y is getting closer and closer to 0, we have less and less production. Your share of the pie as a producer gets bigger, but that pie is getting very small. So this is the crux of the model, this asymmetric output bounds. There's a natural upper bound on output, but there's nothing in the model that keeps output away from 0. All right, so that's the sketch of the ingredients. It's not as structured as is in the paper, for example, but I hope I conveyed some of the main ingredients, the lack of symmetry in terms of the impact of entry and exit, and then entry and exit costs, I should say, and then the Phillips curve relationship, and then the notion of a Taylor rule. Those are the kinds of ingredients that are floating around. All right, so suppose the central bank wants to achieve a constant inflation rate. It chooses an inflation target. And we've just been discussing what the inflation target to be, but whatever it is, it's got an inflation target. The Phillips curve spits out some output that's consistent with that. You know, you could allow your Phillips curve to depend on the target as well. You know, that'd be okay. So, but in any event, but we have a pi star and a y star that are consistent with each other in the sense they both lie on the Phillips curve together. The Fisher relationship, we've heard some of that as well. Basically, the nominal interest rate has to be to compensate you for whatever you can earn in the real economy, the neutral rate of interest, and then whatever inflation is. And so at this desired level, pi star, y star, here's what your nominal interest rate has to be. So give me an interest rate rule at these that satisfies this. You can always find an equilibrium where output is a target, inflation is a target, and the world is the way it should be. But can there be other outcomes? So if I tell you what the nominal interest rate is at this desired level of inflation, this desired level of output, then there can be an equilibrium in which this happens, but there might be other outcomes. And can we have outcomes in which inflation is too high? And the answer is, and as I say, this is suggestive of earlier results, is no, as long as the real interest rate goes up with inflation and output. So if inflation is going up, so if output goes up, then this minus PC of y is inflation, that's going up, but we need the nominal interest rate to go up even more. And that is saying the nominal interest rate is going up more than 1-for-1 with inflation as inflation goes up. This is the so-called Taylor principle, active rules, however you want to frame it. Then output can never be above the desired level. You can prove that that's going to be true. And the intuition is coming off of, if output is above that target level, then interest rates keep on. The only way you're going to be willing to demand that much is given that the output is above target and interest rates are high now. Why are you demanding so much if interest rates are high? Well, it's because you expect a very high output, a very high level of consumption in the future. Times are going to be really good in the future. And so you're willing to demand that much today. But why are you willing to demand so much in the future? Well, you've got to expect even more in the future and down the road. This is an upward growth spiral, but that can't happen because it would lead output to grow without bound, and you hit this choke point where all the firms drop out. So an active rule will kill the possibility of above target inflation in this world. Now, on the other side, result 2, you don't have some choke point for the firms. So you can pick any interest rate ruler you want, pick any output that you want below target, any inflation associated with it. It's also going to be below target, it's weekly so. And then there's going to be a large set of outcomes that are all expectationally driven, where the initial output inflation is given by whatever you picked it to be, and it could be anything. And then output inflation then fluctuate randomly forever over time, but below the desired levels. Okay, so you start, and this is all driven by demand effects. So the natural place for output to be, in some sense, is the Y star you're aiming for, but you can't get there. You're always below that Y star. So this is your target. This is below. You start below it, and by I say pick, it's not you as a central bank. It's the modelers picking this. You're just saying, no matter, pick any bad outcome, you can support it through bad expectations. Now, why is that? Well, anything that can occur today, as long as people expect prices to be low, expect prices and output to be low enough in the future. And it's the reason they're expecting, they don't like low output is because that would mean they're going to consume very little. They're going to consume very little. Well, they're going to cut back on consumption today because of the fact that they've always want to smooth things out over time. Things are bad in the future. They're going to be bad today as well. And so these demand And then everything is self-fulfilling if next month's or next period's, next year's expectations are sufficiently low. So we end up with these expectational effects. The possibility of exit can rule out arbitrarily high output expectations, kill upward inflation that's driven purely by expectations, but nothing rules out low output expectations and low inflation.
I just want to let you know that you're at the 30-minute mark. It's good. You got lots of time. Just want you to let you know that.
Well, thanks a lot, Chris. And that's great, because I have about 5 to maybe 10 minutes of material left. So, all right. So inflation. So the properties of these low inflation equilibria, where inflation and output are all below target. Well, inflation and output are always below target, as I already said. Labor share is low, profit share is high. So this is because average cost, when output's low in this model, average cost is low. You don't have to pay, you don't have to pay that much for workers because they're all competing with each other. So their wages is going to be low. You don't have to pay a lot to them. Labor share is low. And the nominal interest rate is always below target because it's a function of inflation and output. They're low, and so it's going to be below target. So we're going to have low nominal rates, low inflation, low output, low labor share, all the things that you hear concerns about. Obviously, now we hear COVID-19, we hear lots of concerns, but even at the end of 2019, you heard concerns about these features of the advanced economies. All of them emerge in this setting. Now, growth is a little bit more complicated, and I won't go through it, but I think the main punchline is if the Phillips curve is flat enough for low output, so that inflation, you get stuck at basically what happens is the notion that when the output is low, inflation stabilizes at a too low level. So you think about output, and we've seen this in the data, so for that, I have that much going for me here in claiming this, that we've seen very low levels of resource utilization, high unemployment in many countries without seeing much. We're not seeing inflation fall well below target. Even in Japan, inflation got to zero. You didn't have to see persistently spiraling down deflation. If you have Phillips curve behavior like that, then these low inflation equilibria are also going to be marked by low growth as well as low levels. So, summary: 20th century, central banks learned how to get rid of expectationally driven high inflation. We all read Clarida, Golly, Gertler, and figured out you got to use active rules. Okay, and so it was successful, and now we don't have any problems with inflation being above target. 21st century problem: if you're trying to target pi star and y star, whatever those happen to be, then you're going to have this problem: inflation and output being perpetually below target. Labor share and nominal interest rates are going to be too low, and everything's being driven by the long run looks bad, intermediate periods look bad, today is bad. So that's the 21st century issue. So now we get to the crux of this conference, which is about lessons for the Bank of Canada. In this model, you can't rule out these equilibria with any kind of forward guidance. Level targeting doesn't help. These kinds of guidance simply are not going to have any bite as long as people believe that output inflation are known to always be below target. Now, in a world, and we talked a little about this on Tuesday. We often imagine there's a world where the central banker speaks, and the word, the target, the change in target immediately becomes a focal part of people's brains, and then people say, the central bank is saying that inflation is going to return to 2% or 4%. We will immediately believe that will happen too. In the Bank of Canada's case, it will be within 18 to 24 months. In the US's case, eventually. And so, but of course, there's no reason why that should be true in the world, right? And so if we're in this world where expectations are simply shaped by expectations, then there's no reason why this guidance is going to have any bite. In the models in the paper, quantitative easing is really irrelevant. I'm not alone in this in most current macro models. Certainly we have, to be clear, there are models where it does have bite. My own reading, you know, I think quantitative easing was a mostly harmless exercise by the central bank, by the central banks who used it. I think there's not a lot of evidence that quantitative easing has a direct effect on output and inflation. But more tellingly, I think that it's really an important part of this is that any transitory intervention in this world may not help, because any transitory intervention may simply trigger a reduction in people's beliefs about the long run. You know, we worried a lot about this when I was at the FOMC, that you say, oh, we're going to come in and declare that interest rates will remain extraordinarily low for the next 2 years. Fine, you say that. Well, what does that mean and what people are going to expect about after 2 years is over? Well, it might well mean they think things are going to be much worse after that. So your words that are designed to provide support could trigger people to have much worse beliefs about the future. There's nothing to pin that down. They know you're not going to go above target, consistently above target, because you've got this ability to raise rates in an active way and kill those equilibria. But they don't know that you can keep inflation from being persistently below target and output being persistently below target. So the U.S. Fed has this line, and this is its most recent long-run goal statement. The inflation rate over the long run is primarily determined by monetary policy, and the committee has the ability to specify a longer-run goal for inflation. I think recent evidence and the theory I'm describing here both suggest this thinking is false. I think theory and data are driving us that really central banks operating on their own. So here, everything I've been doing here is fiscal policy is passive, fiscal policy is in the background, not trying to help out with keeping the price level from falling too low. Over the longer run, central banks can only deliver on ceilings and not targets. Can fiscal policy work together with monetary policy? I think there's some interesting work on the theory side. There's a lot of work in what's called the fiscal theory of the price level. John Cochrane, probably the most prominent proponent of this, although there's certainly others, Mike Woodford and Eric Leeper, early proponents, and Chris Sims, early proponents of this idea. And this is basically that if you were to grow government liabilities fast enough, nominal liabilities fast enough, you'll end up with inflation. We heard this. David made reference to this on Tuesday, and Luba did too. Look, we're printing enough money. We've got to get inflation. I think that there's some controversy about that view, to be clear. But what is agreed upon in the theory, at least, is it has to be a permanent commitment. Anything that's short-lived, by short-lived we mean 10 or 20 years, people might think you're going to undo it on the backside. And so it's got to be a long-run permanent commitment to government liabilities. There are some interesting ideas about minimum wages. I'm going to push that, but I'll mention it. Andrew Glover has a nice JME recently. Olivier Blanchard has been pushed this idea as well. It's just not enough to do something that's going to last for a decade or two. This is the one thing I want to say, that you have to have something that is viewed as truly permanent. Whereas all the conversation about government liabilities is, well, we got to print a lot of them now for COVID-19, but eventually we're going to get this under control. And even in Japan, you'll always hear, eventually we're going to get this under control. That doesn't work. We know that won't work. That won't necessarily work. I think the Japanese experience, I think David highlighted in his comments on Tuesday that, it's not clear how committed the Japanese have been to fiscal support for demand. But with that said, I still view this as a cause for concern, that it may not be, even the two arrows might not be enough to get inflation and output back to target. So I think it's a very interesting problem. I think that the last 25 years have been surprising, that it looks like the problem that we have with our fiat money system is, how do we get inflation and output from being too low relative to desirable levels? That's something that I think it's going to have to take a joint effort between fiscal policy and monetary policy. What that will look like exactly, I think we definitely need future thinking and research on that. Thank you very much for listening.
Thank you very much, Narayana. That's great. Very thought-provoking. I have been watching the chat room. I have 3 people so far on the speakers list. First up is David Andelfato. Second is Mick Devereux. Third is Sylvain Leduc. And I am open to more because we've got lots of time. So why don't we start with David Andelfato?
Hey, Narayana. Intriguing talk, as always. It'll take me time to fully absorb everything you're saying. Just one quick note on, you noted the active rule in your setup is able to kill the inflation because people are forward looking and they have to form these expectations off into the future that ultimately is unsustainable. And my immediate thought was, oh yeah, I see. You've got some really rational expectations happening there. But at the same time, I'm wondering, is there some tension in your model in terms of your Phillips curve specification is kind of relying on kind of maybe a weakening of that hypothesis? So you kind of, your Phillips curve is kind of going against it. I'm just wondering how to square these two things. They seem kind of be at odds with each other.
Yeah, so I think that's a great question. I think that the answer is that I am relying on a lot of rationality in looking forwards, as you're describing. I could weaken that and still get the same kinds of results. So if I do a little perturbation on that, I will still get the same kind of killing of these above target equilibria. I don't need the full rationality of the hyper rationality we assume in forward-looking behavior. So it is a completely different part of the model. So there's no logical disconnect. But I agree. If I'm going to relax rationality in one place, I should be willing to relax it someplace else. But my point will survive that.
Mick Devereux, you're number 2.
Let me unmute. Incredibly interesting, stimulating talk, Narayana. And I guess I'm on the West Coast, so I still have an afternoon to read your paper after this session ends. So that's what I'll spend the rest of the afternoon doing. Just a couple of quick comments. I mean, I didn't actually see, I'll have to read the paper, but I didn't see like where aggregate demand comes from. You don't seem to have like a consumption smoothing household, or maybe you do, I don't know. I didn't see the kind of standard IS curve at how it works. That's one quick kind of note. The other thing is, how in the downward, below trend inflation, how does this, is this similar to the kind of liquidity trap, the perils of Taylor rules because of, this lower bound, the kind of Benapee, Schmidt-Grohe, Uribe outcome? That's just a question, and the last thing is just a very glib comment related to David's comment. If I look at this Phillips curve, it's kind of pre-Friedman presidential address. So this seems to be like a permanent non-neutrality built into the model. Maybe we have to do that, but we are talking about decades of experience. So, there's some issue there. So, okay.
So those are great points. Mick, I'm sorry, could you remind me your second point?
Is it,
Oh,
how is
Benavides
it related to Benavides Schmidt-Grohe Uribe's?
So there is an IS curve in the model. It's just a standard consumption smoothing. So there's a U prime today is equal to expectation of U prime beta.
Okay, right.
Or expectation U prime in the future. Yes, it's in there. And it's basically, as David was alluding to, it's just a consumption smoothing motive that gives rise to, that's how the future feeds back to today, is all through that equation. And but even if you weaken that mechanism a little bit, you're still going to have that's a pretty powerful mechanism, as many have talked about. So you're still going to have that same force. This point is more general, I think, in useful ways than Benavides Schmidt-Grohe Uribe. Their points seem to rely on inflation becoming deflation at some point in order to get a constant level of consumption. That doesn't happen to happen in this framework at all. And so you could have inflation stabilizing at a relatively high level, and that's at a positive level, for example. And you're just going to have then the real interest rate will always be too low, and it's because people always expect consumption to keep falling. But possibility of that. And Friedman was working in 1968. He was remarkably prescient for the decade to come. I am simply offering I'm playing an easier game. I'm doing hindsight over the last 25 years, suggesting that maybe maybe the model he offered wasn't the right way to think about the last 25 years.
Okay, Sylvain Leduc, you are next, and on deck is Steve Ambler.
Yeah, hi, Narayana. Thanks for the talk. I just wanted to sort of compare the theory you have with the evidence, I guess. So yeah, we have inflation below target. Over the past 10 years, the decline in the labor share has been going on for a few, like 2 decades at least now. I'm wondering about how people perceive output growth, though. So over the past 10 years, we've had the longest expansion on record, and we brought a lot of people who were outside of the labor force back in work, and the strength of the recovery and the length of the recovery, as led policymakers to continuously bring down their estimate of the natural rate. And so everyone was surprised by the strength of output, not by the fact that it was so low. So in the model, I get that we're below potential because inflation is also below target. But I wonder if people perceive it this way. And the same thing is true in Canada, as a matter of fact. I mean, before pre-pandemic, you had the strongest employment growth in several parts of the country. And so maybe if you could speak to that, how should we think about that? These expectations are people really seeing growth and employment to be that weak?
Yeah, I think, I'm living here in upstate New York, and I can certainly find people who have been surprised on the downside over the last 20 years around me. No, but a more serious answer to your question, I think, the data are the data. The output is surprisingly low relative to what it was a dozen years ago. Labor share is low, and a lot of the concerns that are couched in terms of inequality, some of them are, boy, the 1% are earning a lot, but some of them are really about workers not getting their share out of things, and that the Fed pats itself on the back about low unemployment. Those will be quickly to say those jobs are pretty crappy. So I don't see the data as really speaking that, I think I think the issue with the data is not that, boy, things have really been really good and somehow GDP is lying to us. It's really more, maybe this is as good as we can do. That's really the issue that John Fernald will be quick to say, look, productivity growth was super fast for a dozen years, but that doesn't mean it's going to be permanently fast. And you, Narayana, are simply setting up a straw man of maintaining that fast productivity growth. And the same thing could be true about labor share. It's really technology that's driven that. I don't have a great counterweight in my model except to say, boy, inflation remained very low for a very long time, right? And if we were running up against the resource constraints of the economy, we would expect to see some inflation. And I think the Fed finally, I might add, has come around this perspective. but that I think it's very difficult, to sort these things out. Is output too low or too? I think really inflation is a key marker in thinking about that.
Thanks.
Okay, next question is Steve Ambler. The two subsequent people on deck are Stephen Gordon and then John Murray. And let me know in the chat room if you've got questions. Steve Ambler, take it away.
Thank you. Hey, Narayana, thanks for a great talk. I'd like to relate what you said to, I think, a sort of market monetarist idea. So you seem to be saying that people are expecting that expansionary monetary policy to be reversed in the future. So they're pessimistic about the future, and that feeds back into the present. Now, I mean, Friedman said sometime in the mid-90s that low interest rates are not a sign of tight monetary policy or easy monetary policy. They're a sign that monetary policy has been tight in the past. And the market monetarists, I think, starting with Scott Sumner, I think he was the first one to say this, that they're a sign that people are expecting monetary policy to be tight in the future. So I'd like you to ask, and then, so I have a sort of a two-parter. And I think you said that quantitative easing was relatively ineffective, and you seem to be, I'm not sure if that's explicit in your paper, tying that to the temporariness of quantitative easing. And we know that central banks can create nominal liabilities. They presumably can also commit to keeping those nominal liabilities in the system, so a permanent expansion of the monetary base. So if they can do that, and if monetary neutrality does hold in the long run, why can't they get inflation up? I mean, I think some people say that if you really want to get inflation up, you can always do that. Just talk to the governors of the central banks of Venezuela and Zimbabwe.
So, yeah, it's not clear that they're following active monetary policy rules in Argentina and Venezuela. So I think it's tricky. But they seem to have had fiscal support. I have to add, they have credible fiscal support for getting high inflation in those countries. So yeah, I'm not going to say that what I think what I'm saying is certainly consistent with a market monetarist perspective. The challenge is that even though monetary policy is expected to be too tight in the future, it's not clear what to do about it in this framing. Because lowering interest rates, the immediate response is, oh, let's cut interest rates even more. But that doesn't necessarily help here because that could simply lead to even worse expectations. QE. So in the models that the model I wrote down, I think most macro models, what matters is really the path of overall nominal liabilities. So when the Fed prints up money, as you know, it's swapping for other pieces of paper that have been created by the Treasury. And that by itself can't really do anything. If the Fed could print money and just hand it out to people, and that grew over time, and so it was really in charge of creating nominal liabilities as another MMT set of people, different MMT set would want us to have, then you could actually start, and people believe that was permanent, then you could actually have some influence. But the Fed's perspective, as you're familiar with, the Fed's perspective on quantitative easing is it was really about, and Mick made reference to this too on Tuesday, it was a sort of a technical attempt to adjust the yield curve. It's really about swapping. So the Fed's view was always, it really mattered that they were swapping reserves for long-term bonds, not for short-term treasuries. And so it's really about influencing the yield curve. And that is what I was expressing more skepticism about. But if you have a way to expand nominal liabilities and people believe that is going to happen, then you can generate inflation, but it's got to be credible. That is permanent.
Okay, Stephen Gordon and then John Murray.
Thanks again, Narayana. That was really, really cool. Although it was I sort of took a very bleak lesson because we've seen quite a few people mention the importance of coordinating fiscal policy, a credible fiscal expansion. And I'm kind of concerned about that because this, as a political economy thing, it's pretty hard to commit governments, especially newly elected governments, to follow the fiscal path set out by their predecessor. And so every time I see, okay, we need a fiscal commitment, I mean, you can one government can perhaps commit for its mandate, but after that it gets pretty dicey. You know, Parliament is very jealous about its power to tax and spend. It's not going to delegate it to something that was signed 15 years ago by, you know, by another government. So this is not just, of course, an issue with your recommendation. It's a general one for many other people. It's just to say that every time I see that, it's like, okay, it's not clear that's actually going to work.
Yeah, I mean, I wrote a post 2 or 3 years ago now where I suggested that central banks should only take responsibility for keeping inflation from going too high, and they should be on the hook for that, and be held accountable for that. And then the fiscal authority should be responsible for keeping inflation from going too low, and that should be the contract. And this paper is a way to provide support for that perspective. I think that formalizes things, and I think it formalizes things in an appropriate way. I think it's the puzzle here is that Steve Ambler was making reference to Argentina and Venezuela. You know, we want to have enough inflation, but we don't want too much inflation. And then the question is really, how do you constrain the fiscal authorities? Right now, even in the advanced economies, the fiscal authorities, you know, we have a lot of debt, but they're still always talking about, we're going to bring it down, we're not going to have it keep growing, yada, yada. How do you get them to get it in the right sweet spot? I think that's very challenging. But from the central bank's perspective, I really think the right way to do this is to say, look, you guys can't be trusted with keeping inflation from going too high. We'll be in charge of that. We'll be the adults in the room. But on the too low side, we got lots of constraints. Why don't you take charge of that? So that would be my own way to divide those powers up.
So right now we have an interval, one above, you know, below, above 1, below 3. Just to remove that lower bound, and it's like, okay, the bank's thing is just to keep it below 3.
Yep, that would be exactly the way I would think about it. Yeah.
Okay, John Murray, and then if nobody else jumps into the queue, I'm going to ask a question. So this is your opportunity to avoid having a question from me. John Murray, you're next.
I don't know if we want to do that, Chris. You asked me a question. But my take, sort of starting with your initial set of charts, Narayana, is a little different, perhaps more in Sylvan's line or vein. And by that I mean, most central banks were targeting total inflation rather than core inflation, so that if you redrew the graphs, I know with a little more certainty the case of Canada, you'd be surprised at how close they always were to 2% and how symmetric they were to either side of that through time. And I suspect for the US, it's broadly similar. So for most of the last 25 years, I'd say monetary policy, whether you were implicitly or explicitly following a 2% inflation target, was sort of mission accomplished, depending on what other duties you'd see the central bank having to fulfill. Not that I don't have sympathy for your asymmetry problem, but I think in many people's eyes, that's more an occasional or a recent problem as opposed to something that's systemic and persistent and observed over the last 25 years. And here I'm thinking of the global financial crisis, and then more recently. But there again, this episodic asymmetry is something we sort of relate to the effective lower bound and the inability to have symmetric and active monetary policy on both sides, as it were. And I note you just said that falling interest rates would not solve your problem. So clearly, it's nothing to do with the effective lower bound, sort of linking this in more practical terms, I guess I just end by saying many of the real economic phenomena you identified, such as low growth, low real interest rates, maybe growing income inequality, falling labor share, people have credited to demographic effects, globalization and technology, perhaps a mixture of all of those, but nothing that monetary policy clearly has control over. So it's not to dispute the other things you identified as being true and experienced. It's just, I wonder if you are, to use some of the words you were just applying, expecting more of central banks than they ever promised to deliver. And they are caught admittedly in a bind right now. But my interpretation would be much simpler. It's just this lack of symmetry with regard to applying monetary policy because of the effect of lower bound.
Yeah, my view is bleaker than that. Certainly, I think, you know, if you have an effect of lower bound, then this problem is definitely there, that you can't lower interest rates further. But in this world, even if you lower interest rates, people can just respond by lowering their expectations for the future, and it's you're always in a trap of expectations that you can't keep up with. So in terms of the inflation data, you know, it's the starting point for this is, you know, we could look at headline instead of core. I on the other hand know the U.S. data better. I don't think the situation. I always, when I give the talk for the U.S., show both. I admit for Canada, I think the headline number looks better. The gap between headline and core is not as pronounced in the U.S. as it is in Canada. I'm not quite sure where that is, but I'm sure there are others who would have a better handle on that than I do. But you know, John, I just think that I worry when I listen to you that I hear the sanguinity with which people have viewed Japan for too long. I just look at Japan and I see the problems that they face. They always seem to come and hit us somehow. And so I think the problem of raising inflation back up to target, I think is one that they've really dealt with and struggled with. And you know, so I take that seriously. Now in the U.S. context, it's very difficult to know if the Fed was really trying to hit 2% for much of this time frame, to be honest. I think it's only in the last 5 years that they've really been surprised by their inability to get to 2% inflation.
No, I take your point on Japan, that there's this Japan exceptionalism, I'll call it, for which many of us don't have answers. And maybe that's the reality. Maybe it's just another way of looking at a combination of phobia over ever escalating debt and where that leads you on the one hand, but as well sort of pushing on the string and the limits of monetary policy accommodation, even if you could lower interest rates in an extreme way. But so I don't have an answer to that good example, but for me, that's an example that's kind of an outlier, just sits there.
Okay, thank you. Nick Rowe has arrived on his white horse to save you all from my question. So Nick Rowe, you are next. And then I think we're gonna actually have 2 more questions before we go. Nick?
Thanks. Am I on? Can you hear me?
Yes.
Oh, great. Thanks, Narayana. In the 1930s, in the real Great Depression, successive countries managed to escape deflation, not by cutting interest rates, but by raising the price of gold, just going off the gold standard. And I think this was seen as a way to signal a permanent loosening of monetary policy. I don't think I'd argue for bringing back the gold standard so that we could then subsequently go off it as a way to create inflation. but perhaps nominal interest rates are really the wrong instrument for central banks to use, especially at a time like this, facing the problems you've analysed. Couldn't central banks use the nominal price of some real asset? Doesn't have to be gold. I like to think of them targeting the price of farmland just as a thought experiment, and escape the low inflation trap this way.
So simply targeting, thanks for the comment. I think it's very useful. I think simply targeting, announcing a target in and of itself, within the model at least, doesn't work because people might not believe you. But the commitment that, so the idea of a minimum wage floor that's growing sufficiently rapidly over time, so a minimum wage is growing sufficiently rapidly over time, which I flashed by at the very end of my talk, that I think is congruent with what you're thinking. So we announced that the minimum wage is now $15 an hour, but it's going to keep growing at 3 or 4% a year, or adding productivity growth as well, and that's going to keep inflation growing at the appropriate rate. There's challenges with that. I think as soon as you identify a real commodity, you have the possibility of introducing distortions of some kind. But this idea that I don't think central banks can do that on their own. I think they're going to need to have some kind of support from the federal, from the fiscal authority in order to make that happen.
Narayana, I'd like to ask you a question, I guess, about microeconomics. So, the focus of your talk here is really about what's going on in this self-fulfilling, this expectational equilibrium with low inflation, because you are able to prevent that from happening with high inflation. And the mechanism you used to prevent that was this average cost that rose with output. So the microeconomist within me that every once in a while sticks his head out, wonders why that's sensible. So we're talking not about a very short period of time. We're talking about a longer period of time, I think, here. Are there really big enough scale diseconomies that lead to this average cost to rise without bound? Or are these external diseconomies of scale? Because I'm not sure I buy either of them at the level of the economy. I mean, I might buy them for a firm in some situations, but not for the level of the economy. So maybe you can easily come up with some other mechanism to snuff out those expectational equilibria, but this one is just bugging me for that reason. So can you comment on that?
Yeah, it's, at the end of the day here, labor is your scarce input. And, if I wrote things down in a standard New Keynesian kind of formulation, what's happening here is that your demand for labor is growing a lot, and to get workers to work, you need to pay them to work, and that's your fundamental scarcity here is on
you're hitting labor force constraints, basically.
Exactly. Yeah.
Okay, I'm going to turn it over to last question, I think, is back to David Andelfato. And then I'm going to wrap it up by posing the poll. So Nick and Katrine, if you're in the behind the scenes, let's get the poll ready for after Narayana gives an outstanding answer to Andelfato question number 2.
I feel privileged to be able to give 2. Thank you. I have a lot of questions, but we can talk some other time. But just when you mention Japan, so many people do mention Japan as a special case. And I always kind of scratch my head, and I'm really curious to know what we are talking about here, or what we are afraid of. Your paper is more geared at kind of a secular sort of story, a secular stagnation story, I think, but you can rebut me on that. But when I take a look at Japan, a lot of people, when they look at Japan, I think they're looking at nominal GDP. We know with low inflation, possibly deflation, and population shrinking, that by that metric, Japan doesn't look like it's doing very well. But of course, if you go back and you kind of like deflate things and look at real per capita GDP growth, in fact, Japan seems to have outperformed many countries since the crisis. Notwithstanding, they've had a bit of bad luck with the tsunami, kind of aborted the recovery in 2011. But labor market looks pretty good. I mean, you go visit Japan; it's a very vibrant economy. I mean, it's growing pretty rapidly, especially relative to its counterparts. True, inflation is low. The main concern might be something what Doug Laxton referred to yesterday was the ability of the central bank to respond to a negative shock like the one in 2008. But even in that case, you could argue, I mean, there was a lot of fiscal space in principle to accommodate that. So with the proper fiscal stabilizer in place, even that would not have been a problem. Do you see something else? Am I missing something here? Or what do you see that we have to be afraid of Japan?
Well, I think there's two answers to your question, which is, it's a good point. The first point is that, if your desire is to hit inflation as a target, which, we've been talking a lot about, Japan represents a little bit of a warning, right? That you've got central bank trying, you've got a ton of debt, lots of paper floating around, and it's been very difficult to hit that target. Now, in terms of the real costs, we don't want to look, even for the U.S., I don't want to exaggerate. I'm not talking about we somehow rolled back to a 1960s level of development. It's nothing like that at all. We're talking about at its most, maybe a 10 to 15% kind of gap, which still makes the U.S. Richer than its neighbors. So these are like on the output side, on the real side. I think there are issues associated with low inflation, but it's not like you go to Japan and it suddenly looks like Vietnam. It's not. That's not at all what I'm talking about.
Okay, folks, I'm going to bring this to an end. Narayana, thank you very much. That was a very thought-provoking talk, and I look forward to digging through that. And I have a feeling that if I just waited a few more seconds or minutes, there would be more questions. But we'll just bring this to an end and respect the time deadline for the end of this session. The time has come, folks. This is the end of day 3. The time has come to once again think about your ranking of the 6 options that we are examining in this conference. So there they are in front of you. Please choose only 3, and we'll see what happens. Nick and Katrine, I think I'm not allowed to vote. Is that correct? Somehow that's a deep cosmic injustice.
Even more injustice, I'm not allowed to vote.
Okay, well, as long as everybody is voting, vote once, vote with, with happiness. Okay, we've got 29 people out of 41. So let's get another 5, 6, or 7, 8 votes in there, folks. Keep it going, keep it going. We've got status quo. Status quo has jumped to the lead. Dual mandate is still in second place, is now in second place. It was in first place before. We've got a minute left. If there are 5 or 6 other people who haven't voted, please jump in there and vote, folks. No mail-in votes in this election. Everything's online and live. Okay, it's settled down. So why don't we close it up? Okay, so there it is. So status quo at 78%. I think that is about 15 percentage points above before, if I'm not mistaken. Dual mandate is second place, but it's in absolute terms, it's about where it was. So then some other adjustments in the others. So folks, let's bring this to an end. If you could have that sitting ovation, somebody used that term this morning. Somebody, we could have a sitting ovation for Narayana. That'd be great. And we will see you back in this, not actually this Zoom room. It'll be a different Zoom room. But tomorrow 1 o'clock Eastern, we are going to have Michelle Alexopoulos, who's going to give the case for the status quo. So we'll see actually, you know, whether she's able to swing the vote above or below 78%. But Michelle talking about the status quo, and then we are going to have a 5-person panel of wise monetary policy people that I look forward to moderating, and then that will bring us to a close. So goodbye for now. Thank you very much for hanging with us. I hope you're enjoying this as much as I am, and we will see you all tomorrow.